If you're an investor, you're probably interested in knowing how much your portfolio is going to perform in the future. So today we're going to analyze 3 portfolios and we're going to see how much wealth you're going to be able to create in 10, 20 and 30 years. Now look, we all know that past performance is not a guarantee of future results, but we're going to do our best to try to estimate a true long-term growth with these portfolios. Remember that the key to successful investing is investing for the long term. So no matter if you're a value investor, a growth investor, or you just take the safest route and invest in a broad-based index fund like the S&P 500, in all cases, the success you have with your investing has to do more with the time that you stay invested in the market than the actual investments that you make, assuming that you invest in solid ETFs, of course. If you don't know me or my channel, my name is Rick, an Italian investor with a passion for creating content, but not much luck with my YouTube channel. So if you think I do an okay job and you want to help me with my motivation, well, I'd really appreciate if you subscribe to the channel and drop a like to this video. Thanks. But now everyone, let's get to the core of this video, the portfolios. We're going to analyze 3 great portfolios and see how they might perform in the next 10, 20 and 30 years. The first portfolio is going to be a simple 1 ETF portfolio made of VOO, the S&P 500 ETF from Vanguard. The second portfolio is going to be 40% VOO, 30% QQQ and 30% SCHD. And the third portfolio is going to add a little bit of global diversification with VXUS. So we're going to have 30% VOO, 30% VXUS, 20% QQQ and 20% SCHD. Now let's give you a really quick overview of these ETFs. VOO is the biggest ETF in the world per assets under management and tracks the S&P 500 index, meaning it contains the 500 best and largest companies of the American stock market. QQQ is the largest growth ETF in the world per assets under management and it tracks the 100 greatest growth companies. They are the ones listed in the Nasdaq 100 index. SHD is my favorite value and dividend ETF and not only gives a good and stable dividend yield of around 3.5%, which is more than generous, but it's made of companies that actually showed a wonderful capital appreciation since inception of the ETF. I usually suggest using SHD to balance QQQ so that you have a balance between the growth sector and the value sector. And why is it important to balance the 2 sectors? Because they are the 2 opposites of the market that tend to overperform and underperform each other periodically. The growth sector is made of companies expected to grow revenue and profits faster than average. So high innovation, reinvest profits, little or no dividends. This also means that the growth sector tends to have a higher overall performance in the long term. But unfortunately, it's also the part of the market that gets overvalued really easily, because the fact that there are higher expectations of revenue and earnings growth usually makes people overly optimistic. On the other hand, the value sector focuses on companies considered undervalued compared to fundamentals like earnings or assets. So steady cash flow, established businesses that often pay dividends. Now, the risk to reward ratio with value is less flashy, more stable, and therefore they're good for income and long-term value. The last ETF is VXUS, the Vanguard Total International Stock ETF. This ETF is going to give you exposure to international equity markets, excluding the United States. So global diversification with over 8,500 companies across Europe, the Pacific, emerging markets, and Canada, as well as a good market capitalization coverage with large, mid, and small cap stocks. What you always need to consider when investing internationally is the risk. Investing in VXUS means exposing yourself to currency fluctuations against the dollar, political instability, and economic variations in foreign markets, which in the past decades has led to a higher volatility compared to investing in the US market. Alright, now let's get to the interesting part and let's ask ourselves, how are the portfolios going to perform in the future? For example, do you know that QQQ has grown 18% per year in the past 5 years? This obviously means it's going to return 18% forever, right? No, unfortunately, it doesn't mean that. I'm telling you, sometimes I wonder if my channel would work better if I just promised the impossible, but that's just not who I am. I want my few viewers to hear things how they are, not how they wish them to be. So when I think about the growth sector and QQQ, you see, QQQ did return around 18% per year for the last 10 years. But do you know what this 18% is actually composed of? As the great John Bogle taught us, return is composed of dividend yield plus earning growth plus or minus the change in PE ratio. So let's say that you invest $1,000 in an ETF like QQQ. After 1 year, it gives, let's say, 0.5% dividend yield, which is reinvested, and the companies inside it have a total real earnings growth of, let's say, 5.75%. What happens is that your portfolio in a normal environment would grow by 6.25%. That is 0.5 plus 5.75%. But this is never how it really works. In the real world, during periods of bull market, which can last even decades, people are overconfident that the stocks are going to grow further. They keep buying and the price increases more than this 6.25%. Let's say people are going crazy and buy it so much that the total growth is 18%. So the price grows 18% instead of 6%, 3 times as much. Let's make it even crazier. Let's imagine that people are so crazy that they don't do this for 1 year, they do this for 5 years in a row, inflating the price every single year. After 5 years, earnings and dividend yield have grown with a total of 35.5%, but the ETF has grown 127%. This sounds crazy, right? Would you believe me when I told you that this is actually what happened to QQQ in the past 5 years? I collected the earnings per share data of the Nasdaq 100 and its performance in the last 20 years, and I was negatively surprised to see that in the last 20 years, the earnings per share of the Nasdaq 100 grew 623.63%, while the price of the index 1,278.79%. This means that the price grew double as much as the earnings. Now, taking the formula from John Bogle, return equal dividend yield plus earning growth plus or minus change in PE ratio. And knowing that the dividend yield of the growth sector is usually quite low, with around 0.5%, you can see that around half of the performance of the growth sector in the past 20 years must be due to an increase in the PE ratio, or price to earnings ratio. In other words, year after year, investors became more and more willing to pay higher and higher valuation multiples for growth stocks because of their strong future growth potential. In fact, let me show you the development of the PE ratio of the growth sector in the past 20 years. And as you can see, it pretty much doubled in 20 years. So why am I telling you this? Not to destroy your dreams of making tons of money with growth stocks, but simply to tell you that, in my opinion, we can forget about seeing 18% per year with growth in the future. Maybe I'm wrong, I hope I'm wrong actually, but I don't think I am. One thing I can say though is that growth companies typically reinvest a big portion of their earnings into the business to make it grow. This reinvestment lowers the EPS, or earnings per share. So growth companies have lower earnings also because of this. So considering all of this, I believe that the growth sector will give us an average return of around 12% per year in the long term. But there will be a huge correction at some point in the next years. I don't know when, but 38 PE ratio is quite high. On the other hand, for the S&P 500, I believe the long-term return will still be around 10%. Just like it's been since many decades. And also in this case, I expect a big correction in the months and years to come, because honestly, even the PE ratio of the S&P 500 is, in my opinion, way too high. When it comes to the value sector, and in particular the ETF SCHD, I'm going to assume around 10% long-term return. SCHD is not a broad-based value ETF. If it was, I would have said 9%, but being SCHD is such a sophisticated value ETF, I believe it will return more. The last one is VXUS, that has grown at an average of 5% in the past 10 years. For the international market, I expect a higher return than 5% per year, above all now that the US is going through some difficult times with increasing national debt, the weakening dollar, and the difficult political situation. So I expect the international market to deliver around 7% per year in the future. So how much is your portfolio going to return in the next 10, 20, 30, or even 50 years if you invest in the 3 portfolios that we mentioned? First of all, we need the average return. As I always do, I created a table to help me calculate this. So starting by the average future long-term returns, we set 10% for VOO, 12% for QQQ, 10% for SHD, and 7% for VXUS. Portfolio 1 is going to be 100% on VOO and 0% on all the others. Portfolio 2, we set 40% VOO, 30% QQQ, and 30% SHD. Portfolio 3 is going to have 30% on VOO, 20% on QQQ and SHD, and 30% on VXUS. Assuming you start with $1,000 and you want to invest $500 per month, this is what the portfolios are going to give you. Let's start with a simple S&P 500 ETF investment. Portfolio 1. In 10 years, your investments are going to grow to $105,000, and with 3% average inflation, they're going to lose around 25%. And this means that in the future, those $105,000 are going to be worth like $78,000 today. And this value here is called inflation adjusted, and it's important because it gives you a much more important information about how valuable your portfolio is actually going to be. Now, in 20 years, the $105,000 already grew almost 4 times, reaching a portfolio of $387,000, which loses around 44% to inflation in 20 years. In 30 years, Congratulations! Just by investing in the S&P 500 $500 per month, you're going to be a millionaire. But what most people don't tell you is, look at this. 58.8% is lost due to inflation. So it's actually going to be like if you had $473,000 now. What I want to say with this is that if you really want to make real money in the stock market, you need to be ready to invest more every month. For instance, if I'm able to invest $1,000 every month, already after 30 years, I can basically retire with over $2 million in my portfolio, which are going to be like almost $1 million today. And if I invest even longer, for example, from when I'm 18 to when I'm retired at 67, I'm going to have $17 million before inflation. Now, let's see the other portfolios. First, let me get back to $500 per month. Portfolio number 2, with QQQ and SHD in addition to the S&P 500, is going to return better thanks to the growth sector, with around $1.3 million after 40 years, or $539,000 inflation adjusted. Portfolio number 3 instead, $1 million or $425,000 inflation adjusted. This, of course, assuming the future long-term returns like we did before. Feel free to pause the video if you want to see all the results, because now I want to show you how it changes if you invest instead $1,000 per month. And as you can see, $1,000 per month is actually what you need to invest in a good ETF portfolio if you want to become a millionaire in 30 years with a regular job. Your portfolio is going to be bigger, around $2.5 million, but losing 59% on inflation, you're still going to have the same buying power that you have today with $1 million. And remember, inflation doesn't care if you invest or not. If you invest, you might lose 3% per year due to inflation, but you also earn 10%. If you don't invest, your money just keeps losing value, and no matter how old you get, you're always going to have zero. So invest, guys, invest everything you can because it's important, because you want to be financially safe, because you want to be able to have a family and take care of your children, and why not? Because you don't necessarily want to work until you're 70 if you don't have to. And look, if you can invest at least $1,000 per month, then becoming a millionaire is going to be quicker than expected. But even if you can't invest so much, whatever you invest is going to be helpful, and with time, it can still grow to incredible sums. Believe me, even if you invest $200 per month, in 20-30 years, the sum you've achieved is going to be much more than what most people around you are going to have, all right? So start investing, and if you want to see something more of this ugly face, you can check out this video here, or maybe this one. Take care, guys. I wish you a great day or evening. And as always, I'll see you in the next video. Ciao.